Mutual funds have been around for over 100 years, but ETFs, they are quickly closing the gap fast. And on today's Stocks in Translation, we stock them head to head so that you can pick what's right for your portfolio. Let's start with some simple definitions here. An exchange-traded fund, or ETF, trades all day like a stock, but usually holds a small or a big basket of assets, although some modern ones only hold a single stock. In plain English, most ETFs are passive strategies that you can buy or hold any second that the market is open. Now, with a mutual fund, on the other hand, you have pooled money that might be actively or passively managed, and it's priced only after the closing bell each day. So in other words, you have only one shot per day to get in or out. Now let's take a look at how these two classes of funds stack up against each other. We just talked about liquidity, and that's when you can trade. ETFs trade all day long, and mutual funds only trade once per day after the close. When it comes to taxes, though, mutual funds can surprise you with a year-end tax bill if they've sold some of their stocks, so you need to do your research. ETFs, on the other hand, use something called in-kind swaps to keep capital gains taxes to a minimum. But ETFs can be structured in different ways, so you got to do your research there too. And now let's talk transparency. Mutual funds have to report what they own each quarter. That's only once per quarter, and they often play shell games to make sure that what they own looks good to investors as of the last day of the reporting period. ETFs, on the other hand, generally disclose their holdings on a daily basis, publish the evening of the close or the following morning. And when it comes to costs, ETFs usually charge lower management fees, but that's also in part because they tend to passively track an index. For actively managed ETFs, like the ARK Innovation Fund, fees tend to be higher, and that also tends to be the case with leveraged ETFs using derivatives and those that track exotic assets like commodities, gold and oil, for example. Now, mutual funds also have to have a minimum buy-in of about $1,000, whereas you only have to lay out the money to buy one share of an ETF, which is usually much lower. And ETFs are very stock-like, so you can buy or sell options based on them or even sell them short. Mutual funds just don't have that flexibility. Now, we already talked about management fees, but when it comes to actual trading costs, mutual funds might slap on a front end or a back end fee called a load. If they don't have it, it's called a no-load fund. And if you're buying an ETF, much like a stock, you just have to worry about the bid-ask spread plus any commissions that might be charged by your broker. So a quick recap here. Mutual funds win for automatic savings plans, and ETFs win in most other places. Now let's check out a couple of charts that show how these two asset classes of funds have grown over the last 4 decades. Mutual funds, they got their start in the mid-1920s, but they exploded in the 1980s. And as you can see by the top white line that shows the number of mutual funds, it's been going sideways since the beginning of the century, with over 6,500 currently, and that's down over 1,000 from the pre-pandemic peak. Meanwhile, the pace of ETF growth has only increased in recent years, with the current total nearing 4,000. And when it comes to assets under management, mutual funds in white up top here have about $22 trillion, which is also the peak from a few years ago. And ETFs in green, they keep rocketing higher, now standing at about half of that, or $11 trillion. The money is moving where the flex is. So the bottom line, if you want speed, tax efficiency, and low fees, ETFs are the toolbox. And if you like set and forget it and automatic rebalance, mutual funds, they still have a place. But always know the rules before you pull the trigger. And stay tuned for part 2 of Stocks in Translation. We are pitting two OG ETFs, SPY and QQQ, against each other, how Spider-Woman helped build the first ETF, and how the Qs turned into the biggest fee machine ever, a piece Invesco now wants back. Don't miss it. And also tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts. Earlier this week, we took a look at ETFs versus mutual funds. And today in Stocks in Translation, we're going to explore two of the earliest ETFs, SPY and the QQQs, and how the asset class has evolved over the last 30 plus years. And first, a recap of the definition of an ETF. These are shares that trade like a stock, but usually represent a basket of assets tracking an index or a theme, though there are exceptions recently. Unlike mutual funds, which trade only once per day after the close, ETFs can be traded bell bell to bell like a stock. Now let's take a look at a timeline that begins in 1993. That was the birth of SPY, and that's what this chart up here is representing. Now this came to pass in early 1993, and it was kind of the holy grail because there had been attempts before to create an ETF, but they had been struck down by the courts. So in 1993, SPY is born, and now you can trade the entire S&P 500 just like a little stock with a low amount of money. Then a few years later, in 1996, we get open-end ETFs, and this is different from the way SPY was constructed. It was a closed investment fund. That makes it more difficult to swap out the shares. But even though these open-end ETFs got the green light, not all ETFs would use them in the years to come, and I'll come back to that shortly. Now, in 1998, at the end of the year, we got a very tax-friendly ruling from the SEC, and this has to do with the way that shares are sold or swapped in. Now, in a mutual fund, if you want to change out a share, then you have to sell the stock, and it actually creates a tax event at the end of the year. So you can get a bill for that, but not in ETFs. They can usually avoid that. So that was a critical distinction that made ETFs more favorable than most the mutual funds when it comes to those taxes. Now let's take a look at the Q here. This launches in May or March of 1999. Kind of a big day there because now you could trade the NASDAQ 100 as the dot-com bubble was still going up. It would have another year or so, and then we would see that nasty fall. By the way, the NASDAQ 100 ETF QQQ, that would lose about 82%, and we'll get to that stat in a second. But fast forward a few years, and in 2004, we get GLD. This is the first physical gold ETF, and the first time we've had a commodity in ETF form. Quickly thereafter, we would get SLV for silver, but then we get others for wheat and coffee and all kinds of different things, all kinds of different derivatives. And then a few years later after that, we got active ETF managers in the game. So now this is kind of like hedge fund territory. This came in 2008, but by the time we got into the mid-teens, Cathie Wood would use this for the ARK Innovation Fund, and she would actively manage that ETF, kind of like a hedge fund. Now we're going to skip forward a few years in time, and let's see, we just did that one. Here, we're going to go to the end of the teens here, and we have semi-transparent ETFs approved. So for some of these active funds or actively traded funds, if you wanted to protect your secret sauce instead of disclosing all your holdings at the end of the day, this would allow you to do that, and that would kind of pave the way for some more active ETFs in the coming years. We still have mostly passive, but it is an improving game for the active managers. And then taking a look just a short time later, we have the ETF rule arrives. This was kind of like the holy grail for ETFs because previous to this, it was very difficult to get these things launched. You had to apply for regulatory relief, and this just streamlined the entire process. And this would really explode the ETF volume, the new ETF launches over the next few years. Finally, not finally, but almost to the end here, we got 2022 single stock leverage ETFs and also inverse ETFs. Those would join the game. Tesla, Nvidia, Broadcom, you name it. We now have, I believe, close to 100, if not more of these. And these are tracked by our friend Todd Sohn over at Strategas ETF Management. He comes out with some interesting figures each week on that. And then in the beginning of 2024, we got those spot Bitcoin ETFs. Prior to that, we had Bitcoin ETFs that were based on futures, but these would really allow investors for the first time to track the actual price of Bitcoin in their 401ks and just have access to it like any other stock. And the last item here, this is not a big sweeping, this is not a big sweeping change to the industry, but Invesco is asked to convert the NASDAQ 100, and that's its Qs fund, tracker from a fixed unit investment trust to an open-end ETF so that the firm, not just the custodian and NASDAQ, can share in the fees. And this goes back to that early decision in 1999 to form it as a unit investment trust, which is a closed-end fund instead of an open-end fund. At the end of the day, Invesco has left hundreds of millions of dollars on the table because of that, but we'll get to some details on that in a second. Next, I want to show you the differences between SPY and Qs over the year and some of the different stats that have evolved. So we've already covered the launch dates, but look at the total price return of SPY. That's up over 1,300% since 1993, and since 1999, we have the Qs up 1,007%. When it comes to the worst sell-off, that would be the global financial crisis, minus 56% for SPY. And then, I think I cited this before, 83% in 2000 to 2002 for the Qs there. That was the dot-com bust. And if you take a look at the management fee, basically half for SPY, that of the Qs, 0.0945 if you're going to add a few decimal points. And the volume on SPY, I believe it's still the heaviest traded ETF in the solar system, 67 million shares per day versus 40 million for the Qs. And then if you were to convert that to a dollar amount, that's 42 billion every single day, and about half of that, or 23 billion for the Qs. Now, the shareholders of the Qs, they're going to vote on October 24th whether to modernize the ETF. And if they say yes, then the trust becomes an open-end fund, letting Invesco keep most of the management fee, worth over $600 million a year based on today's asset base. So if the shareholders give the green light, the changes could go into effect in early 2026. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found every Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.